Good morning and welcome to the Molten Ventures PLC interim results presentation. Throughout this recorded meeting, investors will be in listen-only mode. Questions can be submitted at any time by the Q&A tab situated on the right-hand corner of your screen. Just simply type in your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can view all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand over to Ben Wilkinson, CEO. Good morning, sir.
Good morning. Thank you very much and welcome everybody. We're pleased to present our 6-month results to the end of September. We'll take you through some of the detail of the numbers and also some more of the detail on our portfolio companies. You have myself, Ben Wilkinson, CEO of Molten Ventures, and also Andrew Zimmerman, who will take you through this presentation. Before I hand over to Andy, who'll take us through the financial highlights, I wanted to give a bit of an overview of Molten Ventures for those that may be unfamiliar with us. We are a firm that has been almost 20 years in existence, and almost 10 years of those have been on the public markets. We have about 80 portfolio companies in our listed PLC vehicle, which the ticker is GROW, and we also manage EIS and VCT funds alongside the PLC vehicle. We're a generalist technology investor with deep domain expertise amongst our investment team, and we're investing in companies that are born in Europe. And as you'll see through the presentation, that gives exposure to really cutting edge technology and cutting edge innovation in the companies that we invest into. Over the years as a public vehicle, we have invested over £1.1 billion. And one of the features of Molten, which is makes us stand apart to other vehicles, is that we've actually returned over 700 million of that original invested capital. On the right hand side, we've put an overview of some of our targets. Andrew will go into this in a bit more detail, but we target 20% fair value growth in the portfolio, and as an average we've delivered over that with 26% delivery. And we also look through the cycle at 10% of realizations on the opening gross portfolio value, and we have been pleased to deliver again ahead of that with 14% delivered. When I took over the role of CEO just over a year ago, having been with the business now over 9 years, I focused us on strategic priorities, which were really doubling down on what Molten is very good at and what is our essence as an investor, and also aligning that with where the capital need is in the European ecosystem with our skill sets as an investment team. And that really hinges on investing directly into companies at Series A and Series B stage, where businesses have commercial traction and where they have proof points in their go-to-market journey, and where they will take capital and active management from us to help them scale further on that journey of growth. We are looking to scale the portfolio by running our winners and doubling down on our best companies. And we're also looking to build out third-party institutional capital alongside the PLC balance sheet. And this is really to make sure that we have sufficient pools of capital that we can ensure we can consistently invest in the best companies across Europe as they need to raise their capital. There are, as we'll come to in the market section, there are gaps to capital for this, particularly the Series B stage, which I would consider to be early growth in the European ecosystem. So us being able to deploy capital into that space is obviously differentiated. We've talked to a narrower fund of funds program. One of the ways that we invest capital at the stages before we will put direct money into the businesses is to invest as an investor into seed funds, and we started a program in 2017 to do that. And for the next iteration of the program, we're going to narrow that down to a really targeted group of managers, which really ensures that we can target the capital that we have more into those direct investing and where we see opportunities to grow the NAV. Balance sheet strength is another priority. Clearly having enough capital, be that working capital for the group, but also investment capital to support our companies and to take advantage of opportunities in the market. This is something that we focus on very acutely. And then as we recycle capital coming back to the balance sheet from realizations, we focus very clearly on the best uses of those funds. And we talk about NAV accretive use of capital. And we'll talk to our capital allocation policy a little more as we go through the presentation. but using some of that capital to buy back our own shares and support the share price relative to the NAV has been an important feature, and we'll update a bit more of that in the presentation as well. So with that, I will hand over to Andrew, who can take us through the financial highlights for the period.
Thanks for that, Ben. So good morning, everyone. I'm Andrew Zimmerman, and I'm the Molten Ventures CFO. It's been a busy and a productive period, and there's a lot of really positive news to tell you about. So without any further ado, let me get on with presenting our 6-month results to 30 September 2025. Let me start by saying that I'm really pleased to present these financial results. In the 6 months to 30 September, we have delivered a portfolio fair value uplift, continued to generate strong realization proceeds, enhanced NAV per share returns with ongoing share buybacks in the period, and maintained new and follow-on investment into our portfolio with a robust balance sheet. Gross portfolio fair value, excluding FX, was 6% up, or £86 million, which was comprised of £135 million of valuation uplifts, offset by £49 million of reductions. FX on our portfolio valuations added an additional £11 million in the period, with a weakening of GBP against euro partially offset by strength versus the US dollar. In terms of valuations, market-leading companies still command a premium when raising capital. AI, deep tech, and hardware public company multiples strengthened significantly and lifted some of our portfolio valuations, but this was partially offset by some softening of consumer and SaaS public company multiples, reducing some of our company valuations. It is pleasing to see that some of the premium holdings in the core, like Revolut and ICEYE, are showing really strong commercial traction, which support their increased valuations. So our GPV ended the year at 1.4 billion and our NAV at 1.3 billion, both up on the FY25 year-end position thanks to that fair value uplift in the portfolio. Realizations exceeded investments, with deployment of some of those proceeds flowing out as share buybacks rather than into new investments. So realizations to 30 September were £62 million, with an additional £25 million realized since the end of September. So we are ahead of track for the current year. The exits included Freetrade, List, and a couple of partial realizations of Revolut in secondary deals led by Revolut. It's worth highlighting once again that these exits were at or above our holding value, providing further proof points of our robust valuation process. During the 6 months, we invested £33 million into our portfolio, with more since then, and I will come on to that shortly. We also completed more than £19 million of share buybacks in the first half of the financial year and began a further £10 million programme in November, recognising that the current discount level between our share price and NAV makes buying our own shares an attractive NAV accretive proposition. General admin expenses for the period to 30 September 2025 were £12.1 million, an 8% reduction versus the same period last year. This reflects our ongoing efforts to streamline operations and improve our cost to NAV ratio while maintaining investment in critical areas such as investment team talent. Operating costs net of fee income were 0.1% of NAV, well below the targeted 1% guidance. So we ended the period with our NAV per share at 724 pence, up nearly 8% from 671 pence at the year end. Our cash position was £77 million, with that further £23 million subsequently received post-period end from the partial realisation of Revolut. In addition, our managed EIS and VCT funds held a further £23 million ready for investment, plus we have an undrawn RCF of £60 million available. So we are in a strong, solid balance sheet position. So we target annual returns of 20% through the cycle, and we have delivered an average annual return of 24% since IPO. However, it's also important that we get back to growth in discrete years, so it's obviously pleasing to see that coming back. You can see from this chart that after the peak in FY22, we were quick to take valuations down in FY23, with things starting to stabilize in FY24 into FY25, and we're now seeing growth start to come back through in FY26. We are optimistic that this growth will continue into the second half of the year, with us holding at sensible valuation marks and strong tailwinds for a number of our key holdings in the portfolio. Obviously, we never want to call the bottom of any cycle, but we are positive about our portfolio of companies and their prospects moving forward. And it's really encouraging to see that there are some signs of life finally coming back to IPO markets and to corporate activity. The key message of this slide is that our experience and expertise as a firm means that we can balance risk and deliver returns through the cycle by investing in this diversified portfolio of great companies. Okay, so this next slide is a similar story to the previous slide, but around realizations. Obviously, we need the portfolio to grow, but we then need to turn that to cash at the optimal point for each investment. We target annual realizations of 10% of the portfolio through the cycle, and you can see from the chart that since IPO, we have delivered average annual realizations of 14%. It's a similar pattern to the previous slide, with strong levels of proceeds peaking in FY22, followed by a marked slowdown in FY23 and FY24 as market conditions changed and exits became difficult. FY25, however, was an exceptionally productive year for realizations, and it is positive that we've been able to maintain that momentum into FY26, with 62 million received to the 30th of September from exits in Free Trade, List, and one tranche of Revolut. An additional tranche of Revolut in October means that we are at 87 million in exits for the current year already, and we continue to work hard on crystallizing further potential exits in the portfolio. So again, this slide demonstrates our ability to manage through the cycle. This is a key feature of the Molten Ventures model. The evergreen balance sheet allows us to allocate liquidity to fund the next generation of category-leading transformational technology companies, balanced with returning capital to shareholders through our ongoing share buyback program when the share price discount to NAV means that buying our shares is a NAV accretive proposition. So the PLC deployed £33 million into investments during the first half of FY26. Since then, we've deployed another 17 million, and we continue to work on deal flow of exciting new investments. Ben will talk more about our portfolio companies later, but just to call out one example across each of the different types. In the 6 million of new deals, we invested into General Index, a data-driven energy pricing provider for global commodity markets. In the 5 million of follow-ons to support the scaling of our existing portfolio, we invested into Mana, which is a pioneering drone delivery company in Ireland. And those of you that have heard me speak before know how much I love talking about this company. The 16 million of secondary was into a Speed Invest continuation fund. These secondaries complement our direct investments as they give us attractively priced access to some later stage companies which we know and which should generate strong realizations in a shorter time horizon. And then finally, we invested 6 million into our early stage fund of funds program and early bird, which help us to feed the pipeline of future winners in our portfolio. So you can see from the chart on the right-hand side that we are getting back to more of a normal cadence of investment after a more capital-constrained FY24 and FY25. You may also have seen that we've just announced a 12 million Series B lead ticket into Modo, a market data platform redefining benchmarks for batteries and electrification assets. This is a good example of the refocus that Ben was referring to earlier into our Series A and Series B deals and backing our future winners. So it's pleasing to see a stronger overall fair value uplift in the portfolio in the first half, building on that modest return to growth in FY25. And I'll come on to some of the key drivers in this slide. We've talked about investments and realizations and FX. In terms of the main drivers of fair value growth, the leader was the core portfolio. Again, we'll talk about that in a bit more detail shortly, but a fair value uplift of 92 million or 11% is much more where we want and expect to be. The earlier stage fund investments were also positive, but there was a slight net down of 13 million in the emerging portfolio, which I'll now come on to in the next slide. So we've listened to feedback from shareholders and analysts and other stakeholders about adding some more visibility in our presentations on the companies outside the core. As these will include the next generation of future winners in the portfolio, we absolutely agree. So we're going to try and shed a bit more light on them now. As well as this slide, there is a lot more material on our website and in the appendix of this presentation. And Ben is going to come to talk about some of the specific companies later. But I would encourage you to access all that material. So there are 68 portfolios in this emerging cohort. The average age of the investment position is 5 years, and the average size of the investment cost is £4 million. However, there's obviously a wide range of investment and sizes and maturities within this. The range of smaller initial positions, which is about 76% of this cohort of companies, enables us to scale up in them as conviction in the emerging winners grow through follow-ons and involvement in further raises. So over time, these ones should become part of the 24% where there's more than 5 million invested. And then in due course, some of them should grow to become the next generation of the core portfolio. In terms of the fair value movement for the period, you can see that the majority of companies had fair value uplifts, which reflects good progress within these. Although there were less companies with the write-downs, 3 specific ones resulted in this small overall fair value decrease for the period. So as you know, we like this fan as a way to visually represent the core portfolio fair value and the movements in the different holdings. Note that the scales are slightly different left and right, with Revolut on the left obviously having very strong growth and skewing the scales slightly. So we've split it to make it easier to see. So starting on the right-hand side and working towards the largest fair value holdings, SimScale, which is a cloud-native simulation platform, has had strong logo acquisition and revenue growth and strong ARR retention. Izar Aerospace, which is space rockets, and hopefully some of you have seen the videos online. It's a really exciting business. First test launch of their rocket unlocked capital at a 1 billion valuation, so that's been a strong growth story. Thought Machine, which is cloud-native core banking software, was one that we pulled back the valuation at the interims last year with slower go-live activation of their client base. But since then, there's been really steady improvement with continuing client wins and continuing ARR growth. And so further growth is enabling a gradual continual walk up in the valuation of this business. ISI, which is a synthetic aperture radar satellite. So rather than cameras, they use radar to visualize things. So you can see through cloud, they can see at night. A really interesting business. Market comps have obviously increased strongly with the tailwinds in this sector. And they've been winning a lot of revenue contracts from numerous European governments because of the defense angle as well as the civil angle in terms of the images that they provide. Coach Hub, which is an enterprise staff coaching platform, was one that we pulled back this period. It was profitable, but the revenue growth in that had stalled. So we've reduced the premium to the market comps for that one accordingly, while that business works on fixing that and getting back to more venture growth rates. Aircall is an AI-powered cloud-based business for communications for enterprises. It's a really good business. It's profitable and consistently growing at more than 20% per annum. More than 20,000 businesses using it. So a good growth story. Ledger make hardware wallets and accompanying software to store crypto and NFT. Again, market comps have been really positive in that sector with tailwinds, especially from the US. And as well as that, the business has had really strong revenue growth and an improving revenue split between hardware and software. And then finally, Revolut, which I'm sure everyone knows, is still growing really strongly with good customer acquisition and revenue growth. We're holding this based on commercial milestone traction, but obviously with that US, the $75 billion round that they just announced the other week, there's room for our valuation to grow further in the second half of the year. So just in general, it's good to observe that visually there's a lot more green areas across the fan, and the breadth of growth, I think, shows the quality of our portfolio with good momentum and maturity for a number of these companies. So looking ahead, we're optimistic. We built on our year-end results, and our exciting and diversified portfolio has delivered a stronger fair value uplift, with NAV per share increasing by 8% in the 6 months to 724 pence. With our evergreen balance sheet model, the ongoing good level of realizations is returning capital to the balance sheet, and we have continued to take a disciplined and balanced approach to capital allocation between new investment and share buybacks. So with that, I'm going to hand back to Ben to talk to you a bit more about the actual exciting companies, our portfolio, and the outlook. Thanks.
Thank you, Andy, and it's very helpful to have that overview of the highlights, but also a bit of the detail of what's driving those numbers. What I'll try and capture here in the portfolio overview is a bit more detail on how the value of the portfolio breaks down, some of the sort of key drivers in terms of the metrics that drive the growth, and then we'll get into some of the specifics of the portfolio companies as well. In the left-hand side of this chart, you can see the gross portfolio total value of 1.4 billion, and that the top 16 companies that we call the core are the majority of that value with 888 million. And then in the remaining portfolio, we have a split between the direct holdings, which we call the emerging. There's 256 million of value there. And then in our fund investments, we have 293 million of value. So substantial value below the core, even though, of course, we focus on those businesses, and we'll try and give a little bit more detail on how that breaks down. On the right-hand side, you can see from the fund investment perspective, we have the fund of funds, which is the seed investments that we've made into seed funds. There's about 80 funds across Europe that we've invested into, and that gives us quarterly reporting on about 3,000 underlying companies. So this is very helpful for us to look at future pipeline. It gives us geographical reach beyond the UK market, and also gives us insights into which of the companies and subsectors are performing very strongly. We have about 82 million invested into early bird funds, which are those remaining value outside of the assets that are held within the core. And then we've invested into secondaries, which is a topic we'll touch on in more detail. From the core portfolio perspective, we're seeing strong growth. Andy's outlined quite a bit of this in terms of 40% growth of the revenue, and it's the commercial traction in those businesses which is driving the fair value growth in our underlying portfolio. I'll point you to the average holding period that we've had with those companies of about 6 years versus the age of those businesses at 11 years, which suggests that on average we've had about 5 years of traction in those companies, building out their profile, building out their product and their teams, and getting their commercial traction before we will put in a direct investment into those businesses. On the emerging portfolio, so this is the direct 68 companies where we have 256 million of value. We've shown on the left-hand side the years that we first invested in those businesses, and you can see that there's a real spread of the vintage of those investments going back to 2017. And then on the right-hand side, you can see the split between the quantum of revenues in those companies, with 44% of those businesses having over 10 million of revenue. So a degree of maturity even within what we consider to be the emerging portfolio. So coming to some of the specifics, we have our largest holding in Revolut. There's 152 million of fair value. Revolut is a business that's been scaling and growing very strongly. As Andy said, they announced their latest investment round just the day before we put out our interim results at a 75 billion valuation. We're holding it based on the commercial traction of the business, and helpfully Revolut have put out that their revenue for 2024 was $4 billion and showing about a 30% EBITDA margin. So demonstrates the growth with 72% growth in their revenue just in that year, and now above 65 million customers and roughly targeting to 50% growth for the coming year. So it gives you a real sense of, one, the scale of the business, but two, that they continue to grow at very high rates. And now with over 65 million customers, they're adding about 2 million customers a month. So that growth continues, and it's very much on the growth path to eventually IPOing. Seems to be their stated aim as a business, and that's been targeted within the next 2 years. We put here an exit horizon of 2 to 4 years, but clearly the company have stated a target to IPO of around 2 years. And that just demonstrates the maturity that we have in a lot of those core portfolio companies, where there is now a horizon to seeing them turn into cash. The next business that I'll point out is ICEYE. ICEYE is a Finnish company which has low Earth orbit satellites that can take images of the Earth. Those satellites have a synthetic aperture radar technology, which allows them to take images through cloud cover and at night. And they're imaging areas of about 400 kilometers, but can also get down to granularity of centimeter detail. So it's very strong technology, and it's had over 400 million of contracts from governments, leaning on security and military applications. But there's also an application for monitoring of wildfires and floods, and selling that data into environmental agencies, but also into governments and to insurance. So it has a real mix of selling hardware products, the actual satellites themselves, and the data alongside them. So very strong traction within this business. Looking at ISAR Aerospace, Andy touched on this a little. They had their rocket launch earlier this year, and it was their first test launch of the full rocket, bringing together over 100,000 different component parts. They had a technical success in terms of reaching the milestones they wanted to achieve, with about 30 seconds of time in the air and a safe landing of the rocket, but also clearing the launch pad. And that delivered for them an uplift in their valuation, unlocking additional capital. They are now looking to do a second launch, which we believe will probably be either towards the end of this year, but clearly we're getting pretty close to that, or potentially into Q1. So certainly will be in the next few months that we'll see something coming through here. What is very attractive for us is not only the fantastic technology of this business, but the commercial traction that's already happening in the company. If they get that rocket launched, there's a really strong pipeline of demand to use the rocket to reach low Earth orbit. Ledger is another company in our portfolio that we invested in around the 2018 period. This is a hardware wallet for cryptocurrency and blockchain and digital assets. And it also has a signature layer that allows for the customers to do in-wallet trading. And so it has a blend of hardware sales, but also some of the reoccurring revenue that comes from the trading of the underlying assets. Also performing very well, strong business, has over 8 million devices sold and roughly 20% of the cryptocurrency market on its devices. And we're seeing a lot of institutional traction now as blockchain and cryptocurrency become much more mainstream, particularly in the US market. And then we wanted to show a little more on some of our emerging companies, those that sit within that 256 million of value. Starting with B0, which is a carbon rating agency. They assess carbon offset projects and have a database of getting on for 500 projects that they sell into customers as a software product. That's a business that's also been growing very strongly, been in our portfolio for about 3 years, and last raised a Series C in the prior year with a 32 million raise, taking their total funding to over 100 million. Again, demonstrates a degree of scale into these companies. The next business we invested in over the prior year is called Deciphex, which is an Irish company that focuses on AI-enabled and powered pathology, and it's looking at AI models which are improving the pathology workflows, efficiency and accuracy. So this is selling into large pharma principally. Staying on the space theme, we have a company next called SatView, which is thermal imaging of buildings from space. In a similar way to some of the other space companies, this has a very strong pipeline of customers and demand, once they have their next satellite, which will be HotSat-2, up and launched in low Earth orbit and operational. And then finally, Manna, Andy mentioned already, is a business that's delivering food delivery in Ireland by their drones, and they have already over 200,000 deliveries, so it's substantially ahead of a lot of its competition in terms of the data and the accuracy that they're able to demonstrate. And they're currently in Dublin and 3 to 4 sites in Ireland, but they're going to expand that to roughly 11 sites, and expanding also into Europe and the Middle East. So a lot of activity and traction in those companies. And as Andy mentioned, Modo Energy is a business that we've just invested more capital into, which is focusing on the electrification market and the data and analytics that go with that, and selling that product into customers that need to assess those underlying battery storage and wind and solar assets that are powering that electrification. So you can see there's a real breadth in terms of what we have invested into, but also a maturity to these companies, and they're all in those exciting sub-technology areas of the market that you would like us to be giving our shareholders exposure to. I said we'd touch a little more on secondaries. Secondaries is one of our strategies for creating value. In a primary investment, we'll invest directly into the business, and the average age or average hold period for those companies tends to be around 7 years. We sit on the board, we're very active with those companies, we help them scale and grow. With secondaries, we're looking at companies that are already at a more mature stage, and quite often we'll transact in secondaries by buying out fund positions from existing LPs that may already have made some money, but those funds will be beyond their 10-year life. And that allows us to get direct access to those underlying mature companies, and usually turning them to cash through realizations in a shorter time horizon, much more akin to 3 years versus the 7 years of a primary investment. And you can see here that we've had very strong returns from that strategy, with a 2.4x average combined secondary return across the 6 investments that we've made over the last 9 years as a public company. And this last slide demonstrates the returns and the spread of those returns from a multiple perspective, and a percentage of invested capital across those realizations of over 700 million that we've had since we've been listed. And what this really demonstrates is the importance of portfolio construction. We are in the risk business, we are taking risk on these underlying assets, and I would argue if we weren't seeing some zeros in those companies and some less than 1 returns, we wouldn't be taking enough risk. But you can see in venture capital, the strength of the returns is really determined by how many of those winners in the 3x plus brackets that you're able to get value into, and to ride those winners over the long term and support those companies as they scale. So it's very much a business that requires risk taking. It's very much an asset class that's skewed to the winners in terms of the returns, but it requires a lot of private market management skills of those underlying companies in the portfolio. So that portfolio construction point is very, very important to how we deliver over several market cycles and how we deliver these underlying returns to shareholders. Touching briefly on the market environment here, we have seen in Europe that the investment capital on the left-hand side has been fairly consistent over the last few years, coming down from the peaks in 2021, 2022, and that's been overlaid with technology valuations and interest rates, which are factors that come into how much capital is deployed. We've seen that on the right-hand side, that's been going into fewer companies. So the number of deals has reduced over time, even though the amount of capital, that quantum of capital, has remained rather stable. In the areas where we invest, the cohorts would be in that 10 to 20 million, which is sort of the pink bars you can see on the left-hand side. And it's remained fairly stable in terms of numbers of deals and the quantum of capital. But you can see that as companies start to scale, there is a narrowing of the capital that's available for those businesses. So coming to the outlook, I said at the outset of this presentation, and I won't dwell on them too much, what our strategic priorities that we'd set out are. You can see through the results that we've been delivering on those. with our investments in the period into Polymodels, General Index and Joule, plus what is now announced as Modo Energy, a follow-on investment at Series B. So very much sticking to the areas that we want to be deploying capital into, the right balance of risk and upside. Scaling the portfolio and bringing in third-party capital, we have a strategy, Molten East, which will be a fund that's looking at the Eastern European part of the ecosystem, and particularly the engineers and the talent that comes out of those regions, and that's moving towards a first close into next year. And then narrowing our fund of funds program, we've already spoken to a lot of the managers in the ecosystem, and new commitments are going to a much narrower cohort of managers. But we are still very active in that part of the market in terms of supporting the companies and ecosystem that we're already invested into. And there's a lot of value there, as we described earlier, 120 million of value in those fund of funds already. Balance sheet strength is a key focus for us, continues to be. Realizations obviously support that. And as we've seen the scaling of companies like Revolut, we've been taking some of our value off the table as they continue to grow, leaving enough for the upside, but making sure we're sensible about our portfolio management, and then recycling that capital into new opportunities to continue the growth of the NAV, and looking at the growth of those companies over the coming cycles as well. And then with that return of capital, we've had 41 million up to September that we've put into share buybacks. So reducing down the number of shares that we have in circulation by buying them where the share price is attractive. We're effectively buying our portfolio at discounts. And then we've announced an additional 10 million to that program to ensure that while that elevated discount persists, we can make sure we're supporting the share price and driving that NAV per share return. So I think in terms of the overview, we've covered quite a lot of the positive fair value growth in the portfolio. Certainly seeing the breadth of that growth has been important, and growth of 6% in the portfolio, leading to 8% growth in the NAV with those the benefit of those share buybacks. So I would say a strong first half of the year performance. Capital return to the balance sheet, we've talked to the 85 million now post year end. I think that's even slightly higher than the 85 that's come through, and that's clearly supportive of future investments and us going through our capital allocation policy and looking at the most NAV accretive beneficial use of those funds as they return back to us. And then that strong performance, that 8% that we touched on, and that continued deployment, really strengthening our brand in the market and taking advantage of our existing networks and our existing proprietary opportunities that we have to put capital to work and to see the uplift in those NAV numbers as we see the growth in the fair value of those underlying companies. So I think there we will pause. There's a lot more in the presentation that it's available on our website, and we will at this stage go to questions, but of course do encourage you all to sign up to our newsletters, which give a lot more detail on the assets as we travel through the year, and then making sure that you can spend some time on the appendices in these presentations, because we do give a lot more detail on the underlying companies and the shape of the portfolio.
Fantastic. Ben, Andrew, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions just using the Q&A tab situated in the right-hand corner of your screen. Just while the team take a few moments to review those questions submitted today, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Ben, Andrew, as you can see, we've had a number of questions throughout today's presentation. Thank you to all the investors for submitting those. If I may just ask you just to click on that tab, and just where appropriate to do so, read out the question, give your response, and I'll pick up from you at the end.
Super, thank you, Paul. And thank you everyone for submitting questions, but also for your attention in the presentation. We recognise this time of year is busy with corporate reporting, so certainly appreciate your attendance here. So the first question I'm going to look at, it says we highlight a number of investments that are maturing and then thinking about those exits over the coming time period. In the core portfolio in particular, we do highlight quite a lot of those companies like the Revoluts of the world, Ledgers of the world, iSize and Aircalls that are at that level of maturity where we could see a pathway to those companies exiting our target returns are 10% of the gross portfolio value, but we call that a through the cycle target because, of course, we don't know exactly the right point to achieve those exits and achieve the right value for those businesses. Quite a lot of our companies will have stated ambitions of IPOs potentially, be those in the US or in Europe. But 85% of our exits are through trade sales to corporates. So more often than not, that tends to be the route that those companies go down. But we certainly see a lot of maturity in those companies, and we see the possibility of turning some of those back to cash in the coming years. Deployment of capital is the next question, which effectively follows on from realizations coming back to the balance sheet. We follow our capital allocation policy, which looks to that NAV accretive best use of the capital across three areas. One is primary investing, where we go direct into those companies. The second is secondary investing, where we're investing into more mature assets or portfolios of assets. And we can usually target those secondaries with a discount because you're providing a liquidity to an illiquid part of the market. And it gives us greater visibility on those mature assets in terms of their scaling journey for the coming years. And then the final part is looking at the share price and how the shares are trading relative to the underlying value of the assets and the portfolio, which is the NAV per share. And clearly, in the last year or two, where we've had discounts to that share price versus the NAV per share, we've been buying back our own shares. So that's the other use of capital that we will look to. And that can be a moving equation of thinking around what is the most NAV accretive use of those funds. And so we'll assess each of those three areas at each point. There's a question here about diligence on our underlying companies. When we undertake investments, we're investing at the critical cutting edge of innovation. And so we are ahead of the curve. A lot of the businesses in our core that we're talking about here, we've invested in for 8 years plus. And you can see, therefore, that the diligence of the underlying technology is an important feature of what we do at the time of investing. Some of that diligence will come through the domain expertise in our team, but we'll also use external providers to come and diligence assets, people either through our own network of investors and entrepreneurs that we've invested in over some years, or even third-party specialists. There is a question here on Saba as an investor in our stock. And it says, how are they influencing your management of the business? The reality is they have a TR1 in the market to say that they are an investor in our stock. We welcome all of our shareholders to be active and recognize the value that we have in the shares, particularly while they trade at a discount to NAV. You can see from our capital allocation policy that we are very focused on creating value for shareholders and narrowing that discount. And so ultimately, we'll treat Saba like everyone else in our share register. We are engaging where people would like to engage with us. We'll report to them like we would everybody else. And we think all of our shareholders are aligned in wanting to see growth in the value of the company. So that's very much aligned with our board and our management as well. There's one here I might ask you to take, Andy, because it talks to more the valuation process. It says, can you describe a bit more detail on the multiples of revenue used for the core valued and the discounts that may be there in the pricing points, and particularly for companies that aren't yet at profitability? So I think it might be worth, Andy, you giving a bit of an overview of how you approach that valuation.
Yeah, so just, and there's detail in the appendix of this presentation, which has the basis that each of the core companies has been valued on. There's a little letter that indicates it. So for companies that are valued on a comps basis, there's like a basket of publicly quoted companies that are not identical, obviously, because a lot of these are new and innovative businesses, but are closely aligned to these businesses as possible. And you take those revenue multiples and get that basket of them and compare them alongside the ones that you have. So, and then you can have a premium or discount depending on how the portfolio company is doing relative to that. runway lengths for those companies as well, we've put a slide in there about that, which just shows how well funded they are. We don't break it down by individual company because of commercial confidentiality reasons, but they do all have a robust capital runway and revenue growth prospects.
Thank you, Andy. Just going to a few more of the questions. There's a question on our market cap and the discount to NAV. I have touched on the realizations and the apportionment of capital back to buybacks. So I think that's a question we've addressed. There is a question on capital intensive companies, and I would say the majority of our businesses are software companies and therefore very much capital light, focused on data and software and selling into enterprises. There are a portion of our companies like ISAR Aerospace, which will need more capital as they scale. We wouldn't be the source of that capital, and therefore the question is, could that dilute your equity position? And if companies raise new money, it can dilute our equity position. That is a feature of the model, but quite often those companies are raising at higher valuations. So that level of dilution and then not taking capital from ourselves is a trade-off that we're happy to take and is part of the model. Clearly, when our companies scale and grow, if we feel that they're growing at the rates of return that we would like to continue on that journey, as we've seen with Modo Energy, we'll double down on those companies and put more capital to work. So we're always assessing the return that we see versus the price of those underlying investment rounds. So I think with that, Paul, we've come to the end of the questions. And again, I'd just like to thank everybody for their time and their interest in Molten. And I think that interest is well placed because we have a lot of exciting companies in the underlying portfolio. I think investing in European technology is a very exciting period, particularly over the next 5 to 10 years, as we see generational shifts in technology. And I think Molten is a partner that can give people access to those underlying technology shifts and the growth that comes with those as they disrupt markets. So I encourage you to stay with us as we show you more of our companies over the coming reporting periods.
Fantastic. Ben, Andrew, thank you indeed for updating investors today. Please ask investors not to close this session. You should be automatically redirected to provide your feedback in order that the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Molten Ventures PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good morning to you all.